Welcome to The Explainer. Today, we're diving into a really fascinating and maybe a little crazy strategic pivot from one of the biggest names in finance, PayPal.
I mean, think about it. Why would a payments giant, a company that literally makes money on transactions, deliberately try to process fewer of them? It sounds completely backward, right? But believe it or not, there's a really surprising story unfolding behind the scenes, and they're making this huge bet that, yeah, smaller can actually be better.
And let's be clear, we're talking about an absolute titan of the industry. I mean, they processed over $458 billion in payments in just one quarter. That's a mind-boggling number. But here's the twist. That massive size was actually hiding a really big and growing problem.
All right, so let's get into it. Let's unpack this core dilemma PayPal was facing. It's a real puzzle, one that basically forced them to rethink what growth even means for them.
So, you've got this weird situation, right? On one side, the total amount of money they're processing, their payment volume, it was growing and growing. But on the other side, the actual profit they were making on each and every transaction was getting smaller and smaller. It's like they were running faster and faster on a hamster wheel, but not actually going anywhere. This is a classic case of profitless prosperity. And for any business, that is a super dangerous trap to be in. So where was all this low profit growth coming from? Well, what's so interesting here is that the source of the explosive volume was also the source of the tiny profits. It all came from their unbranded business, mainly a company they own called Braintree. You've probably used it without even knowing. It powers the checkout for massive companies, but it does it at just razor-thin margins. Okay, so PayPal's new leadership, under CEO Alex Chris, they saw this happening, and they did something pretty drastic. They just slammed on the brakes, hard. And you can see it right here on this timeline. Braintree's volume growth went from a healthy 11% all the way down to just 2%. They were deliberately letting go of that low-margin business. Now, you might look at that and think, whoa, that's a disaster. But this slowdown wasn't a sign of failure at all. Nope. It was actually the beginning of a really bold new strategy. We're talking a fundamental pivot for the whole company. The new mantra, value over volume.
All right, let's get into what this new strategy actually looks like. The first thing they did was change what they measure. They shifted their most important metric away from just looking at the total amount of money processed. Now, the big focus is on something they call transaction margin dollars. It's a fancy term, but all it means is the actual, real profit PayPal makes from a transaction after you subtract all the related costs. This is their new North Star, the number that matters most. And their CEO, Alex Chris, he put it pretty simply. He said, "We have returned the company to growth. The goal here is simple. Get back to profitable growth. Make every single transaction count for more on the bottom line, even if that means you have fewer of them overall."
And this chart? Oh, it shows the strategy in action perfectly. Just look at this. The total number of transactions actually dropped by 5%. But, and this is the key part, the high-margin, really profitable transactions, the ones from their own branded checkout and from peer-to-peer payments, those grew by a really healthy 6%. You can see them literally trimming the fat and focusing on the good stuff.
So that's the big question, right? How do you actually grow the profitable transactions while you're letting the low-margin ones just walk out the door? Well, you can't just cut costs. You have to build a better mousetrap. And that's exactly what they're trying to do.
You know the feeling. We have all been there. You're trying to buy something online and you see the option for guest checkout and you think, great, I don't have to create another password, I'm just going to forget. But then you're stuck typing in your name, your address, your 16-digit card number again. It's so annoying, right? It's a huge point of friction and it's a massive reason why people just give up and abandon their shopping carts. Well, that's the exact problem PayPal is trying to solve with their secret weapon, a new product called Fastlane. The whole idea is to completely get rid of that friction. It's pretty clever. It recognizes you just by your email address, securely autofills all your info, and gets you through the checkout without you ever having to type in a password.
So, does it work? Well, for the merchants, the businesses using this, the results are pretty stunning. We're talking about guest shoppers converting, meaning they actually complete the purchase at a rate that is 50% higher than those who don't use it. In the world of e-commerce, a number like that isn't just good, it's an absolute game changer.
And for you, the customer, the whole experience is more than a third faster. That means less time fumbling with your credit card and, you guessed it, a much lower chance you're going to just abandon that cart.
But get this, it gets even better. For repeat shoppers who already have a Fastlane profile set up, the conversion rate can be as high as 80%. 80. For a merchant, that is basically a guaranteed sale. That's huge. So this is the really crucial part. This is why Fastlane is such a big deal. It completely changes PayPal's whole sales pitch to businesses. They're not just saying, hey, use us, our fees are low. Now they're saying, hey, use us, and we will get you more sales. And that is how they can justify charging a premium for their branded checkout. It lets them fight back against competitors based on value, not just on who's the cheapest.
Okay, so that brings us to the bottom line, the final piece of this puzzle. They have this new strategy, this cool new product. So how is Wall Street reacting to PayPal's big bet?
Well, you might think investors would be thrilled, right? A clear plan, profitable growth. But actually, the market has been pretty skeptical. They've been punishing the stock, pricing it like it's a company in decline. It really seems like Wall Street is so focused on that slowing overall growth number that they're completely missing the bigger story, this strategic shift to profitable growth.
And you can really see just how much the market is discounting PayPal when you compare it to some of its peers. Take a look at its price-to-sales ratio. It's about the same as Block's, even though PayPal is way more profitable. And when you put it next to a high flyer like Adyen, wow, it looks incredibly cheap. And you know, it's not just cheap compared to other companies. It's cheap compared to its own recent history. As you can see here, its price-to-earnings ratio is trading at a nearly 40% discount compared to its 3-year average. It's like the market has basically said, we don't believe in your future growth, and just stripped away its premium. So this all sets up the central debate for any investor looking at PayPal. You've got two clear sides. The bear case says, look, growth is slowing, competition from Apple Pay and others is brutal, and their margins are just going to keep shrinking. But the bull case says, hold on, this pivot to profitable growth powered by amazing tools like Fastlane is going to work, and when it does, the stock is going to be revalued much, much higher.
And that really leaves us with the big question here, doesn't it? At the end of the day, PayPal is betting that a better checkout experience can beat a bigger one. In the fintech wars, a world where scale and size have always been king, this is a really fascinating test. The big question is, will quality finally beat quantity?